Hello, I'm Debbie Bell-Hosking and I'm talking to Lee Fulmer, an industry insider. We've been chatting about liquidity and I just thought it'd be good to hear your views. So where do we start on liquidity, Lee?
Well, I think the first thing is that there's been a lot of regulatory interest over the last sort of 18 to 24 months in the banking industry, specifically in the liquidity space. All the capital ratios and adequacy tests that have been done have more or less proved that the banks have the asset capital and the cash that they need in order to function and survive crises. I think the problem is now as regulators are starting to realize that there are a few really big banks that are responsible for a lot of the cash flow in certain jurisdictions across Asia, across Europe, across North America. And the challenge now is how do we control that flow? How do we actually either slow it down if we need to or stop it altogether if there's a counterparty risk? And that's been the big buzzword. And if you look at Basel III, and what the industry has tried to do there, there is a huge focus on how do you monitor, manage, and control a firm's intraday liquidity flow. So I think, the biggest challenge is people don't understand what that means. And I think people think liquidity and they think it means we have cash in the bank, and it does, but liquidity flow is about how fast that money moves. So it's all well and good to say that you have enough cash to cover your obligations should all your clients want to move or should you need to pay off all the loans. It's a totally different conversation as to how fast that has to happen and whether or not you can control and restrict that flow in relation to another bank. And I think that's what really caught a lot of banks out in 2008, was how do we actually stop the flow of money to a counterparty legally? In some cases they couldn't because contractually they had to send that money. In other cases they didn't. They were just exchanging liquidity and it was going into a black hole because there was nothing coming back. So there's a big focus, I think, at the moment in how do we as an industry look at our practices in risk and cash, and how do we apply that to the liquidity flow rather than just the liquidity? How can we actually ensure that we can slow that tap down if we need to? And it really is just like that. It's like turning the tap down slightly so that not as much water flows out. How can we turn that down and control how fast the cash leaves the organization if we see that a counterparty is not flowing cash to us? But again, we have to be very careful because the regulators won't want us to stop it. So, there are 1,000,001 reasons why a counterparty might not actually be flowing cash to you at a particular time of the day. Could be there's a problem with a market infrastructure. Could be they're having an IT issue. It could just be there isn't actually anything they need to settle and send at that point in time. So you have to use a bit of common sense and a bit of human compassion, I guess is not the right word, but maybe human intuition in terms of understanding what the market's doing. So people are incredibly important to the equation because technology on its own is just too black and white.
Lee, thank you for your time and just taking these few minutes to sit down with us.
My pleasure, Debbie. Thank you very much.
And thank you for watching.